technically we've got this very big technical wedge that's now building inside of interest rates. So something worth paying attention to. There's a trade setting up here. Just don't know which way it's going to break out yet. So here's what you need to know before the bell this morning. Bonds have been, kind of just trapped in a trading range here for quite some time. Yields really haven't gone much of anywhere, despite everybody saying, oh, the yields are going to go to 5 or 6%, whatever. They haven't, and they've just been kind of stuck here around 4.3, 4.4% for quite some time. And that's a function of economic growth and inflation. I had this conversation last weekend with Adam Taggart. If you want to know where interest rates should trade in terms of the 10-year Treasury, it's GDP plus inflation. There's about an 84% correlation historically going back to 1970. But that's just because that's how interest rates are trading off. They're saying if I'm going to loan money, I've got to cover inflation and I've got to cover opportunity cost of investing my capital somewhere else. And so that's how you kind of get to that number. But here's what's going on technically with rates, because you've got a very interesting process right now of a giant wedge kind of getting built into yields at the moment. So yields are going to break out one direction or the other. If they break out to the upside, there's going to be a decent move up to probably 4.8, maybe 4.9% on that. So again, you're going to need some type of inflationary pressure to lift that rate of inflation above GDP where it is now to add to that total return. So if GDP is at 2.4%, and you've got inflation at 2, so it yields straight at 4.4, you're going to need inflation to go to 2.5, whatever, to push that up to there. So again, you're going to have some type of inflationary push to push these yields higher towards 4.8, 4.9%. If the economy slows and we start moving in towards recession, we see inflation continue to come down, we see economic growth begin to taper off, which again, if you take a look at what Goldman Sachs has been saying lately, that's very likely going to be the case. We could see yields kind of break down below this wedge, and again, that would probably put us closer to 4%, maybe 3.5% on the 10-year Treasury at that point. So, but again, just technically, we've got this very big technical wedge that's now building inside of interest rates. So something worth paying attention to. There's a trade setting up here. Just don't know which way it's going to break out yet. So again, just kind of paying attention to that. Outside of that, the rest of the market's continuing to do fine. As we said yesterday, the market kind of started out on a strong foot yesterday, but pretty much ended flat. So we haven't really, we've broken out minorly to new highs, but not dramatically. So again, we're still just kind of this kind of lift that's going on in the market is fine, but we've got a very, very strong rise, but again, another wedge pattern kind of developing here. So again, a breakout to the downside is going to lead to that correction that we're talking about. Now, here's one other fact. We've had the NASDAQ has now traded above its 20-day moving average for over 60 days. That is the longest stretch of the NASDAQ trading above its 60-day moving average since 1999. So again, just a lot of exuberance being built to the markets. Technically, everything is fine, but again, just paying attention to kind of money flows. They are very extended right now. That typically marks short-term peaks in the markets. You got what appears to be an example. If you take a look at retail trading flows, et cetera, those appear to be reaching a level of exhaustion, which is typical towards the end of a move. And again, this has been a very, very big move for the markets. And we're just kind of defining a lot of these compression patterns within the markets, which those don't mean the markets are going to crash. But what it does suggest is that when you get these compressions, it's a sign of exhaustion in the markets, and then the next move typically tends to be in some type of corrective manner, more often than not. But again, this is why we just talk about managing risk, managing portfolios, et cetera. But that's what you need to know before the bell this morning.